昨日行われました
We, the Liberal Democratic Party, received a very severe judgment by the people in yesterday's upper house election. As the head of the Liberal Democratic Party, I apologize deeply for the upper house election result.
That's Japanese Prime Minister Shigeru Ishiba apologising for his party's upper house election stumble. Live from Sydney, I'm Paul Allen. This is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, there's a little movement in Japanese assets as markets reopen following the post-election holiday. Prime Minister Ishiba now promising to focus on securing a trade deal with the US. We'll get broader market insights with Aberdeen Investments, who will tell us why they've been adding tech, Korean stocks and Indian financials. Also ahead, we'll get Indian steelmaker JSW's outlook for the sector as their quarterly earnings beat estimates, but tariff tensions loom. Plus, China launching construction of a mega dam project in Tibet, seeking to energise the economy, but risking fresh tensions with neighbouring India. Well, let's take a look at how Japan assets are tracking in the lunch break at the moment, reopening at the bottom of the hour. But we see the Nikkei just eking out some very, very modest gains there. Nikkei futures, though, setting up for a softer reopen. And we've got a very weak yen, 147.46 following that election result. And that's not the end of it either. Prime Minister Ishiba now has the task of attempting to hang on to his job, so an element of political uncertainty injected there. On the upside, however, there is some hope of striking a trade deal with the US, and there's no obvious successes to take over at the moment either. So for the moment, Prime Minister Ishiba is remaining safe. We'll be keeping an eye on how Japanese bonds perform as well, because of course the long end of the curve has already been pretty weak, and there's an important auction coming up tomorrow. So let's get a little bit more on this now with Bloomberg senior reporter Ruth Carson joining us from Tokyo. So Ruth, let's start with Japanese bonds traded mixed this morning. How sticky are any gains in bonds, and are they vulnerable to some more selling?
Yeah, I think that's the multi-trillion yen question, so to speak, right now, Paul. Just being in Tokyo, talking to investors here on the ground and strategists, everyone is virtually in wait-and-see mode now. For what? More certainty. Let's take a look at what's actually going on. We've got, obviously, political uncertainty, as you pointed out earlier. On the political front, we've got trade tensions still simmering with the August 1st deadline coming up. But more importantly, we also have a 40-year auction tomorrow. All eyes will be on that. Will there be demand? Well, how will the yields go? Who will be soaking up the demand? And what happens if there aren't enough buyers for the bonds as well? So all these are definitely playing on investors' minds right now, not just those in Tokyo, but clearly those overseas as well, from Singapore to London, because long end yields, as you pointed out, have been under pressure, not just in Japan, but elsewhere. But Japan does start the trading day, so people are keen to find out if there will be spillover effects to treasuries, to ACGBs, to gilts, to Eurobonds going forward from tomorrow. So all of this is basically, in a way, crippling traders and making them be in wait-and-see mode.
Yeah, and let's talk about the yen as well. It's now trading around that 147 per dollar level. Is this now the new normal for yen traders? How are investors positioning for this currency?
Yeah, definitely yen trading has been hard work for a lot of people. To put things into perspective, if you look at WCRS, which is a function on our terminal, over the past month, the yen has actually weakened against all its G10 peers. But if you look at what investors and strategists on the street are saying, they're all expecting the yen to bounce back and trade stronger against the dollar by the first quarter of next year. So who's right? who's wrong? You know, how do you position on the yen? One thing that's certainly come up is political uncertainty is not great for assets in general, and that would include the yen. So perhaps some short-term pressure is what's likely the case for the yen. And then if we get a good result, for example, with tariffs, if we get more certainty when it comes to Ishiba staying, or in fact if contenders come to the front, that would give yen traders more clarity going forward as well.
And how about for global investors? What are some of the key elements to watch out for when it comes to positioning on Japan assets?
Absolutely, and this has to be attacked on multiple fronts. On the bond side, more clarity on BOJ policy. Will they, won't they, when will they hike, when is the next hike coming? Should investors get a whiff of more certainty on how the Bank of Japan is likely to conduct its monetary policy going forward, you'll see more certainty when it comes to global investors betting on JGBs. On the yen side, on stock side, a lot of it is also driven by sentiment. So if we get more clarity, a good deal, for example, between the US and Japan on trade, that would certainly bolster sentiment clearly on stocks and the yen as well. So very much all in wait-and-see mode still, but global investors cannot ignore Japan. It's a huge market, be it from the rates front, the yen front, or the stocks front. It's a matter of cherry-picking how you're going to position for it.
Yeah, and certainly a trade win, as you describe, might help Prime Minister Ishiba from joining the revolving door of former Japanese prime ministers. But let's talk a little bit more about the intersection of yen, stocks and bonds. I mean, we'll be hearing from Kyle Bass in just a moment, but he sees Japan preserving the bond market, perhaps at the expense of the yen. What are some of the factors at play here?
And that's a great debate that's happening in markets right now as well. Where is the escape valve for tensions in market, be it on a macro front, sentiment front, or whatever it might be? Mr. Bass obviously made a very, very strong point there, and a clear point about how, you know, the bond market, is it really going to be sacrificed here, or it's more likely the yen? And again, I think that's up for debate. Certainly, traders are weighing that. They are looking at the long end of JGBs, for example, as an escape valve right now when it comes to, you know, unease around monetary policy and term premium. But equally, on any other day, the yen could also take a hit as well. If sentiment dips, be it on a macro front or from the tariff front, often the yen can still get a bit of a bid for its haven qualities. But, you know, if things do improve, who knows, maybe the yen could sell off as well. So it's very, in a way, it's quite messy at the moment.
All right, Bloomberg senior reporter Ruth Carson in Tokyo, thank you. Well, I mentioned there Hayman Capital's CIO Kyle Bass. He is ringing alarm bells on the yen's big swings, and he told us why Japan's currency is particularly concerning for him.
The yen went from roughly 100 to 160, and now it's sitting around, what, 145, 147. So when you think about the yen is just moving in the amount of purchasing power it has in dollars. It's really that simple. And so they're in a really bad situation from a debt perspective. They've got a population decline. They are a very important trading partner of the United States and one of the stalwarts of ours in Asia. So I think we're going to do all we can to trade and help the Japanese going forward. But I think they're in a precarious position, i.e. they either have to let their currency go or their bond market go, and they'll never let their bond market go. So I would beware of the yen into the future.
That's Hayman Capital CIO Kyle Bass there. Still to come, Aberdeen Investments shares why they're confident China's equity rally has legs as we unpack the outlook for Asian markets. This is Bloomberg. Asia stocks mostly flat today amid a busy week for US earnings. Investors are looking for signs of corporate resilience to balance tariff risks. Avril Hong's here with more. So, Avril, the stock rebound taking a breather, including in China today. Some signs, though, that equities there and in other emerging markets could remain supported, though?
Yeah, I mean, we've been seeing already this rebound really solid on the CSI 300 for much of this month. I think it's only declined 3 out of the past 20 plus sessions. Is this idea that the stimulus is feeding through into the economy itself is resilient or looking pretty resilient to these tariff risks? And amid all this, there are other signs as well, including valuations looking attractive. There are some signs that deflationary pressures seem to be easing, or the fears of them at least. We've been talking a lot this week about the expansion of money supply. There's also the normalization of China's 1 and 5 year interest rate swap curve. And that is following a distortion that has actually persisted for much of this year. But not just China sort of phenomenon when it comes to what you're seeing in stocks. EMs in general, they have outperformed developed market gains for much of this year. And part of this is helped along by the backdrop of dollar weakness, but there's also optimism surrounding domestic demand. And of course, some see these valuations in EMs as too cheap to ignore. Have a listen.
The screaming bargains are in non-U.S. stocks relative to U.S., non-U.S. value in particular, emerging markets value in particular, and small cap value versus large cap growth. Our work on developing capital markets expectations shows a 10-year outlook for small cap value of 8% per annum better than large cap growth.
I guess the bigger question, Paul, is whether emerging markets can keep this up for the rest of the year.
Yeah, okay. Well, Avril, do stick around. We can discuss this some more with market strategy. Pruksa Iamthongthong, Deputy Head of APAC Equities at Aberdeen Investment. Pruksa, thanks so much for joining us. I just want to start off with that observation from Mr. Arnott there. Are you seeing any screaming bargains at the moment in terms of non-US emerging markets?
Yes, I think when you look at emerging markets and Asia in particular, we are still looking at pretty attractive level. And if you were to compare where the discount rate between the US stock market and Asia is at the moment, we are still talking at about a very large discount over a 10-year period, and this is after a very long time of underperformance. Earnings is also starting to pick up, so I think fundamentally and valuation-wise, things are actually looking pretty good.
Yeah, on the topic of earnings, they've been somewhat sluggish/bleak in China recently. You mentioned that's picking up. What's your outlook here, and what's your strategy for navigating it?
Yes, I think what we are focusing on since the start of the year to be more focused on domestic equities in China, and this is particularly as the trade uncertainty looms, and as a result, where we find earnings resilience, it tends to be in the domestic market. Other areas where we find more resilience as well would be in high dividend yielding stocks and sectors, whether you talk about the financial space or whether you talked about in the insurance space as well, and those tend to provide a good shareholder capital return. China Internet also does look pretty cheap, and earnings are still pretty resilient on a broader basis, although there have been near-term competition, which the government has started to step in to try to clamp the competitive intensity down, so things should start to look better. Which sectors do you think would benefit the most from some of these government efforts to rein in excess capacity besides tech? We do think from the areas where there are overcapacity, and that's why the government needs to step in. So you can think about the electric vehicle supply chain. That's where there's been talks of a lot of competition driving overcapacity, driving down margins. So government stepping in to rein that will actually bring more logic back to the industry, and therefore improve the profitability. So if you're invested in the market leaders, they should continue to do quite well regardless of what's happening, but the broader industry level should help. What about infrastructure stocks? Do you have any strong feelings about that? I mean, we've been seeing them doing pretty well this week. What do you think about that being a bit of a playbook? We do look at things more on a broader basis. So we have more of like an indirect exposure to infrastructure. So this morning or yesterday we were talking about the big mega dam project in China, and the headlines in terms of infrastructure stocks, we do have exposure to power equipment plays that will also benefit from the big infrastructure spending that's going on. Outside of China, we have the commodity plays that will also benefit from the rise of infrastructure spending as well. So that's why we do look at things from a broader basis to where the supply and demand is more supportive.
Yes, to your point on the commodities, we have seen them rally quite strongly off the back of that announcement of the new dam in China. Iron ore, copper, cement as well, rallying pretty hard. How sustainable do you feel that rally is going to be, though?
Among all those names that you have mentioned, we like the copper subsector the best, and we do think this is where, from the Liberation Day to now, the risk of copper, the downside risk in the near term has diminished, while the upside there still remains. And the long-term interesting and attractiveness of copper very much remains, and there's multiple demand drivers, but more importantly, supply is also pretty controlled, and therefore we do think from a longer term perspective, copper is still the place to be.
You mentioned Liberation Day there. Seems like a natural point to start talking about tariffs. And I'm just wondering how closely you follow the progress of these myriad bilateral talks and trade deals that are going on at the moment. Do they inform your decisions on a day-to-day basis?
I would say less so on a day-to-day basis, but definitely this is an area that we follow very closely. And this is really because we do think that one of the bigger uncertainty right now is still on the tariff front, and this goes down to the level of details of even with countries that have struck a deal with the US, whether you look at Indonesia or Vietnam, it's still not very clear what transshipment actually means and how that trade will get diverted from China to the rest of the countries. And there are still multiple countries in ASEAN and Asia that is in the process of striking a deal with the US until 1st August. So I think still a lot of moving parts with the tariff front to see where we land, how that actually is going to translate into some impact on demand and slower growth in the US, and also how the supply chain is going to cope with it. So we do watch that very closely to see how that impact our companies over the long term.
Yet markets are running ahead, even with the specter of these 19-20% plus tariffs for a lot of these Southeast Asian markets. Are we just being complacent here? When does the tariff pass-through start eating into margins, into earnings growth?
I think the market is running a little bit ahead, and the reason behind this is, where we are today is better than the scenario that was initially painted during the Liberation Day when the reciprocal tariff first came out. But I think if you were to take a step back, we are still talking about 19 to 20% level of increase in tariff, which we do think that the supply chain should have the capability to deal with it. But that also means that everyone along the supply chain, including consumers, will actually have to bear the additional costs, and that will impact the demand. How will this pan out in the end? I think we still got to wait until 1st August, and then after that, a few more quarters to see how that translates into higher inflation and demand impact. So I would say that the picture is not very clear, and yet the market has gone up.
Even if you kind of take these tariffs sort of out of the equation, earlier in the year and late last year, fiscal prudence was sort of a key theme, including for markets such as Indonesia. Singapore kind of stands out in fiscal sustainability. How do you view the market? The Singapore stock market has been on a long winning streak, taking a bit of a breather today, but where do you see the opportunities in the region?
We do see plenty of opportunities within the Asian market, whether you talk about China, India or ASEAN. They all have different drivers, but for ASEAN in particular, I think Singapore has been benefiting from some of the excitement that is going around the rejuvenation of the Singapore stock market. But on the fundamental front, you also see attractiveness in terms of high dividend yield stocks. I think earnings resilience is a key theme that you have with the Singapore companies that continue to provide some of some safety net, if you like, in the current market volatility. Elsewhere in ASEAN, even if you talk about companies in the same sectors like financials or telcos, they have not done as well as the Singapore market, and that is really because economy is still relatively weak, but there are catalysts on the horizon, and especially when you look at the dollar weakness that has been coming on, that has allowed room for the ASEAN central banks to start to ease rates, and that should start to spur and drive economic growth, benefiting some of the earnings of these companies. So we do find those companies pretty attractive as well. It's just that it hasn't been reflected in the stock market yet.
Pruksa, I want to get your views also on the tech space as well. I know you're bullish on Korean, Taiwan semiconductor stocks as well. Where do you put money to work in that space at the moment?
We do put money to work across the supply chain, and I think whenever that there is a TSMC announcement, we do get a sense check of where the industry is. And last week, TSMC had a briefing, and essentially the key takeaway from that is that the growth and the strength of AI continues, and that continues to be where the visibility is. So we are invested across the market cap spectrum in component plays that are linked to the growth of advanced semiconductor as well as a data center upgrade. Increasingly nearer term, we are also starting to see more attractive investment opportunities in the non-AI space, where we think that the demand has already bottomed and we should start to see a gradual recovery, and that has lagged the overall rally and is not yet in the price. So I think broadly, we do think that the tech sector is still looking pretty attractive and have been adding into this whole area.
And of course, we had the story last week that NVIDIA is now going to be able to sell its specifically for China chip back into China. But how long do you see China actually needing this product? How far advanced is China in developing its own tools, and how are you investing around that?
I think what's interesting about China is that with what's shown by DeepSeek, you are able to see China's ability to innovate and China's ability to optimize their solutions as well. So we do think that even without H20, China will be able to optimize its way out and will continue to grow and invest in this AI technology. With H20, of course, with the increasing supply, that allows China to be more efficient in the way that they invest in their data center, in training their chips. But without it, China will continue its pathway. So the way that we are invested here will also be through the beneficiaries of that, which means that the cloud players or the China internet players that are the key players in monetizing this AI trend and really using that to develop more solution for their consumers and driving a new business model and earning stream as a result of that. So we do think with the continued supply of H20, that's pretty positive news for some of these companies as well.
Pruksa, where does this leave the Indian markets? There isn't really a way to play it via AI or chip stocks. IT outsourcing earnings so far have mostly disappointed. How do you see the Indian markets faring beyond financials?
We do like the financial space in India, and that's really because within the financial space, earnings are resilient, but more importantly, with the rate cuts that's coming through, that's helping the liquidity conditions in the market, and valuation is attractive. So financials continue to be a proxy to the economic growth in India, which has been relatively weak over the course of this year, but that is also starting to bottom up. Other ways that we continue to like the consumer plays in India, the aspirational consumption categories of India, whether you talk about hotels, travel, that continues to be one where we see earnings growth coming through, but valuation is also looking a bit pricey as well. But broadly, we continue to like India for the longer term structural growth story, and it's more resilient than the export stories.
All right, Pruksa, Iamthongthong of Aberdeen Investments and Avril Hong, thanks both for joining us. Still to come, JSW Steel's CEO is going to join us to discuss the company's global expansion plans. That conversation in a moment. This is Bloomberg. Welcome back. You're watching Insight. We've got Japanese stock and bond markets just getting back underway after the lunch break. If we take a look at the Nikkei, that's how it was at the close when Japan went to the break, just higher by about 0.2%. Of course, returning to trade after a public holiday Monday, and that followed the weekend's election, which saw, as expected, not really going the way of the ruling party. Prime Minister Ishiba's party suffering a defeat in the upper house elections. We saw a modest pop in the Nikkei, but losing a little bit of ground in the early going following the return from lunch. The other big mover was, of course, the Japanese yen. You see there on your screen now 147.50, weakening quite sharply after that election. And, of course, there are now some questions over how long a weakened Prime Minister Ishiba can last in that role. He does, of course, have to negotiate a trade deal with the United States as well. A significant victory there could prolong his time in office. We'll have to wait and see. All right, let's take a look at how things are going in India. Meanwhile, not a lot of movement on the bond market at the moment. We did, over the past few days, see 10-year yields dipping down just a little, pretty much unchanged right now. We've been watching the rupee as well. It's been sliding for 4 days. It's kind of flat at the moment, 826.25.50. Uncertainty over that trade deal with the US also casting a shadow over India's currency. Right, well, analysts say second quarter margins for Indian steelmaker JSW might shrink sequentially if spot prices keep on trading below the first quarter average. Now, the steelmaker last week reported first quarter profit and revenue that beat consensus estimates. So let's get a bit more on the outlook with Jayant Acharya, Joint MD and CEO at JSW Steel. Thank you so much for joining us today. I do want to start with some of the movements we've seen in commodity prices just recently. I mean, the iron ore price ticking higher. When you're looking ahead to future quarters, how are you hedging around some of these input costs?
Yeah, so good morning, Paul. I think on the coking coal side, we see that the prices have moderated, and that has played into a positive cost profile for us in the last quarter. In the coming quarter, we see a possibility of another few dollars drop. On the iron ore side, I think there has been an uptick internationally. On the domestic side, there has been a price correction with a lag. I think some of that benefit will play into the quarter, this quarter. However, on the structural side, we have taken a lot of initiatives to reduce our cost, and those initiatives are going to play out. Our new operations of 5 million ton JVML is at a much lower cost point, and that is ramping up well. Our expansions in our upcoming upgradation at Vijayanagar for another 1.5 million ton is also going on well. So on the volume side, we see JSW Steel very well poised to take advantage of the growth in India. On the cost side, a lot of structural initiatives we have taken will support us to handle the prices, which are a little volatile as well.
I just wonder if you can tell us a little bit more about your plans to grow steelmaking capacity. How much do you intend to add each year, and is this going to be greenfield growth, or are you looking at acquisitions as well?
So currently our capacity internationally and India put together is about 35.7 million tons. Out of that, 34.2 million is in India. We are adding capacity to the extent of another 1.5 million ton by the close of this year. Our phased expansion in Dolvi is currently on track for the next 5 million, and we should be at a capacity of 42 million ton by September 27. Majority of the growth which we are focusing on is in India because the Indian domestic demand is strong. The Indian economy is doing well. Given global uncertainties, we are investing for some value addition in our US operations in Italy, but our major focus is to build capacities in India. So 42 million by September 27, and we plan to be at about 50 million tons by the end of this decade.
If we just look back on your quarter just gone, the April-June earnings do reflect a rebound in domestic steel prices, as you're describing there, following the imposition of the safeguard duty. But although you do mention that the risk from low-cost imports remains a very live one, can you tell us a little bit more about that and how much of it do you think is due to U.S. tariffs?
So in the recent past, if you really look at, China has been on a weaker domestic growth from a steel demand perspective. Therefore, their exports have been elevated, and that exports from China at about 10 million tons a month is something which is a global challenge. Having said that, the good thing is that in the last 2-3 months, China's production has moderated, and hopefully that will reduce exports in the coming half of the year. The second part, which you asked about the U.S. tariffs and the diversion, yes, U.S. tariffs on steel, which have been imposed, have created changes in trade flows, and we see more steel looking for a home. India, being the fastest growing market, is finding itself vulnerable to those flows. We have seen some countries who have not been there in the past coming up with import offers into India. So even though the safeguard duty has been imposed timely and proactively by the government of India, we feel there is a need to watch out and see that we do not land up getting dumped in terms of steel into India.
We do have to talk about the acquisition of Bhushan Power and Steel as well. I mean, you've filed a review petition with the Supreme Court because, of course, it did reject that acquisition. How do you see a path forward here?
So as far as Bhushan Power and Steel is concerned, just to take you back, when we acquired the unit a couple of years back, it was an underperforming unit. We have been able to turn it around. Profitable entity today. The capacities have been increased to 4.5 million ton. So therefore, the performance post the acquisition is visible. On the Supreme Court judgment, we have filed a review petition. The Honorable Supreme Court is to identify a date for the listing and hearing of this review. We feel we have strong grounds to pursue this review petition, and we are looking forward to discuss it in the court.
And how about if the court sticks to its order? Have you gamed out that scenario? Would you expect to see any impact on earnings if it doesn't go in your favour? As per the Supreme Court judgment, the lenders will have to return the amounts invested to us. And to that extent, I think we are comfortable. Having said that, we have enough capacity addition possibilities in the brownfield and another greenfield site. So from a capacity expansion point of view, we are not so worried. From an earning point of view, also BPSL contributes about 10% of our total EBITDA. The new capacities coming up in our brownfield expansions are good to make that up. So can you see any potential impact from a ruling if the court does stick to its order? Would you have to revise past earnings or anything that extreme?
Difficult to comment on these as of now, in detail because they're sub judice. I think we'll have to wait how the, Supreme Court order plays out and then take a view.
Yeah, and how does that factor into your considerations when you're considering other acquisitions?
As of now, what we feel we have an advantage on is brownfield expansion at very low specific cost of investment. Typically, steel capacity of 1 million ton costs $1 billion or more. We are able to do our brownfield expansions at 50 to 60% of that cost, and that's enabling us to, grow in a healthy manner. Our focus would strategically be on that. If there is an asset which comes up for disinvestment and is a compelling strategic asset, we'll have a look at it.
How about any new markets that you're pushing into? Are you looking to expand in that regard?
In terms of our international operations, we have facilities in US and Italy. The overseas operations in US have done well. I think because of the domestic market in US picking up, that operation is healthier now. The Italian operations are also picking up. It's primarily a production for rail, which is a strategic product for the European market at large. That one is, again, doing well with rail orders, infrastructure build-up coming into Europe and Italy in particular. So those operations we are hopeful would do well this year. However, our expansions, as I said, would remain India-focused, and we would be continuing to expand most of our crude steel capacities in India. Indian domestic market provides a very healthy market for us to grow, and our focus therefore remains here.
One of the stories that we're discussing today is this plan from China to build a new dam in Tibet, triple the size of the Three Gorges Dam. And we understand that this may prompt the Indian government to speed up progress on its own similar project in Arunachal Pradesh. When you consider potential mega projects, what sort of opportunities do you see here for JSW Steel?
So overall, Paul, if you really look at the infrastructure development in India, the government of India is upped its capex on infrastructure spends over the last few years consistently. And I think India has a lot of opportunities to develop the infrastructure across the country, length and breadth of the country. The dams and the bridges and the roads and the highways and the railways and the airports are all part of that capex plan. So we see a huge opportunity because typically, steel consumption, about 60% in India, is from infrastructure and construction, and this is going to drive, I think, major part of the decade or two in India. So very good opportunity as we see going forward in India.
All right, Jayant Acharya, Joint MD and CEO at JSW Steel, thank you so much for joining us today, unpacking those earnings announcements for us, also a look ahead at what the future quarters might hold as well. Also, in terms of the future, let's take a look at Indian markets just ahead of the open. We're going to get the open underway in just over 3 minutes' time. So it's been a really positive setup. We are looking out for a few potential earnings as well. We'll be hearing from Reliance, HDFC Bank. We're going to be looking at whether or not heavyweights like Reliance Industries and other names in banking, metals and cement are going to be performing well or not. We've got the rupee as well also dropping for a fourth day amid equity outflows. This is the market action from the day before. 10-year yields also just ticking down about 1 basis point in the prior session. But here is the setup for the Indian Open in just a couple of minutes' time. Still to come. China begins construction on a $167 billion mega dam in Tibet, despite concerns about environmental damage and the impact on relations with India. We've got more details of that story next. This is Bloomberg. All right, let's take a look at how Indian markets are tracking at the open. The economic recovery has sort of struggled to gain traction in June for a second straight month. We've got a little bit of analysis from Bloomberg Economics, monthly GDP tracker. Worst, though, maybe over. Could be a cyclical rebound ahead. Expected GDP growth of 7% in fiscal 2026. We're seeing some modest positivity across the complex at the moment. The bank index performing pretty well, better by 0.4%. The Sensex, more broadly, better by 1/3%. We do have a fairly weak rupee at the moment as well. Let's take a look at how iron ore is performing. That's the story of the moment. Pretty strong, back above $100 per tonne. This is after we saw China break ground on its latest mega project, a dam which is triple the size of the Three Gorges Dam, which in itself was enormous. $167 billion budget for this, so iron ore rallying hard. The iron ore contract in Singapore, one of the most hotly traded at the moment. We're seeing the flow through to Australian miners as well. One of those, Fortescue Metals, something of a bellwether for iron ore, being its only product, and also China, its biggest customer, better by 2.2%. Rio Tinto there, its iron ore makes up its product, is the largest product that it ships. Rio Tinto better by 3% as well. So that lifting Aussie stocks, the ASX kind of flat at the moment, and if it wasn't for the performance of the materials sector, would probably be in negative territory. Well, despite fueling a rally in commodities, China's new mega dam project is also expected to carry risks, including potential biodiversity loss and fresh tensions with India. The hydropower project is on the Yarlung-Tsangpo River, which also runs through the state of Arunachal Pradesh in northeast India. So for more, let's get to our government reporter, Sudhi Ranjan Sen in New Delhi. So Sudhi, tell us more about this project and its importance.
Well, I mean, the sheer size and scale of the project is enormous. I mean, what our colleagues and we kind of reported that, once it is complete, it kind of comes up with 70 gigawatts of energy, and that's more than what Poland has. And the sheer engineering feat that is there, it's in a very fragile area of the Himalayas, and the drop where the dam is supposed to be is one of the most difficult areas. So in a way, it's an engineering marvel that China is kind of planning once it is through. So and the sheer amount of money that is being spent into it, $167 billion, as you were saying earlier. So it just gives us the size and scope of it. And this project, mind you, has been in the works, or it has been been talked about for some time now. And this it's come out officially from China, and the groundbreaking has happened, making it official. So therefore, there are reactions in the lower riparian states like India. We haven't heard so much from Bangladesh as yet, but this is likely to be a cause of tension, as you were mentioning earlier.
Yes, so tell us a little bit more about how this could be a source of tension. Is there anything that India and Bangladesh can do about this to mitigate the impact?
Well, there's very little Bangladesh and India can do on their own to mitigate their impact. A cooperative mechanism perhaps would help, because mind you, it's a trans-boundary, a trans-border river. From Tibet as it moves into India, it's called the Brahmaputra River. And it is the main source of water for millions of people in the northeast, and for agriculture, for fishing, and so many other things. So any drop in the amount of water in the Brahmaputra or the Yarlung-Tsangpo, as it is called in the upper reaches, is going to have implications. China, as we know, has kind of said that it's a run-of-the-river project, and there is going to be the rights of the lower riparian states will not be violated. On the other hand, I mean, in the India-China relationship, if you look at it, this has been bobbing up and down. But with the formal announcement, things change. India, very recently told its lawmakers that this issue had been discussed with China. One of India's top diplomats who was in Beijing had raised this issue earlier, and India has formally kind of let its concern know last December about it. So things are now kind of bubbling up, and this happens when India and China are trying to mend their relationship from the border skirmish 5 years ago, which kind of led to a complete freeze in the relationship between India and China.
Well, India's, of course, got its own giant hydro project planned for one of those northeastern states in Arunachal Pradesh. Does this change the timeline or the scale of the planning for that at all?
Well, it's in the plans. We haven't heard anything from the government to suggest that there is an urgency to complete that project. And even if that project is completed, whether the environmental and biodiversity concerns, the concerns about lack of water or reduction in the water, or reduction of water in the Brahmaputra, is going to be completely met. We don't have a clear picture on that. That project is in the works, but whether India will be able to kind of fund that project, and how quickly will India be able to fund that project, are questions that need, do not have clear answers as yet.
All right. Thank you very much for joining us. That is our Bloomberg government reporter, Sudhi Ranjan Sen, there in New Delhi. Let's get to some more top global stories that we're following. 28 countries, including the UK, Japan, Australia, Canada and many European nations, have issued a joint statement saying Israel's war in Gaza must end now. The nation's foreign ministers say the suffering of Gaza civilians has reached new depths, condemning the recent killings of more than 800 Palestinians who were seeking aid. Israel's foreign ministry calls the criticism disconnected from reality. Treasury Secretary Scott Bessent is calling for an exhaustive review of the Fed's non-monetary policy operations, and that includes renovations to its headquarters in Washington. The Fed and Chair Jerome Powell have faced weeks of criticism from the Trump administration over the building renovations and for not cutting interest rates again. In a post on X, Bessent says that significant mission creep may be jeopardizing the independence of the central bank's core monetary policy mission. A new report says President Trump's recently passed tax and spending law will add $3.4 trillion to U.S. deficits over a decade. The latest estimate from the nonpartisan Congressional Budget Office also warns that millions will lose healthcare coverage. The analysis doesn't factor dynamic effects like the bill's potential impact on growth or interest rates. Officials and cybersecurity researchers say that hackers have exploited a flaw in Microsoft's SharePoint software, breaching governments, businesses and organizations worldwide. Microsoft released a patch over the weekend, but warns more fixes are coming as attackers continue targeting SharePoint clients. The vulnerabilities were first identified in May by researchers at a Berlin cybersecurity conference. Right, let's take a look at how some of these key assets are tracking in Asia at the moment. In terms of foreign exchange, the yen softening quite a bit following the weekend's elections. We did, of course, see the ruling LDP lose its grip on the upper house, and consequently Prime Minister Shigeru Ishiba's grip on power also somewhat weakened, although it's not clear if any successor would be in a position to take over at the moment, so he's probably safe for now. But at the very least, that does inject a little bit of political uncertainty into the scene in Japan on top of the tariff uncertainty. And we've seen long-dated bonds in Japan suffering a little as well. And we do have a crucial 40-year bond auction coming up tomorrow. Got the Korean won a little bit softer as well against the greenback, and softness for the Aussie dollar too, dipping back below 66 cents. Now, we did hear from the Reserve Bank of Australia a short time ago, releasing minutes from its July meeting, and that meeting was somewhat surprising. The market was expecting a cut, and there wasn't one. The cash rate in Australia still parked at 3.85%. The Reserve Bank in its minutes saying it didn't lower interest rates because that would not have been consistent with its strategy of easing in a cautious and gradual manner. However, bets on a cut at the next meeting increasing sharply. Take a look at what's happening in the US bond space at the moment. It's pretty quiet right now. We've got the 10-year pretty much parked at 436.98. Not a lot of action at the long end of the curve as well. We did see a little bit of softness in yields in the US session there. The dollar spot index just ticking up a little. Before we go, here is a look at tomorrow's show. Allspring Global Investments going to be joining us to discuss market strategy. Senior Portfolio Manager Janet Reiling is going to tell us about opportunities in the fixed income space. And that is it for Insight. Horizons Middle East and Africa coming up next. This is Bloomberg.